Hello and welcome to the third video in the serial trading video series, and we're going to begin our topic here of Elliot waves. So what are Elliot waves? Well, they are recognizable price patterns. They can give insight into the progression and maturity of a trend. They can warn of the potential for trend changes, depending on the pattern in play and the context in which it appears to be in play. They can offer specific levels to define a trend, or in this more important case, a trade against. So that's the real idea here, is not to just be the best Elliott wave analyst out there, even though that might be interesting and enjoyable for a lot of people. The main purpose I see is to inform trading decisions. Okay, can offer price targets based on Fibonacci levels and or wave relationships. So that will be when you're trying to define the potential reward of a trade versus the defined risk. There's some measurements that can be used to inform that decision. More reliable on larger time frames, but can certainly be identified on lower time frames as well. So definitely on the larger time frames, I believe the patterns have more validity and integrity, and that's because it's a lot easier to manipulate things on a weekly or monthly or even daily price chart. But if you're on a 5-minute price chart, there are people that can move the market sufficiently on that low time frame to invalidate what would otherwise appear to be a solid, wave pattern based trade setup. That's why I think it's more important to focus on the larger time frames when using Elliott wave price pattern analysis. Okay, and we're just going to do a basic rundown here. So you can categorize as motive waves or corrective waves. So motive waves are waves that are in the direction of the larger trend, and there's specific patterns that can be identified as motive waves. And then corrective waves obviously are corrective patterns that are counter to the larger trend or direction in play. So let's continue on with the slide here. So here's some just simple line diagram examples. So in a bullish trend, so in an uptrending market, the impulse wave is the first selection here, and that's where you have a 1, 2, 3, 4, and 5 wave move. Now typically there's some rules and guidelines that govern the development of an impulse wave. I'll just do a quick rundown, but it's certainly not comprehensive. If you want more information, you should look at those resources that I referred to in the first introductory video, because there is a lot of nuance to learn here. But let's just get into this. So typically you have an initial 5-wave move up for a wave 1. In a wave 2 correction, you'll be looking for some sort of 3-wave decline. It could be a zigzag, it could be a flat, or it could be a variation of those two patterns. It cannot be a triangle on its own. Triangles can only appear in the 4th wave position of an impulse wave. They can also appear in the B wave position of a zigzag, and the X wave position of a double zigzag or double 3 or triple 3, etc. Again, I'm not going to get too far into those weeds here. So typically you'd be looking for wave 2 to do a relatively deep retracement of wave 1. So it could be anywhere from a 50%, 61.8%, or 78.6% retracement. Those are the 3 most common retracement levels for wave 2, and I believe 61.8% is the most common, according to the Elliott Wave Principle book. Okay, so after you have your 5 up and 3 down for your wave 1 and 2, then wave 3 is typically the longest and most powerful move in an impulsive pattern. And common objectives for wave 3, 1.618 times the length of wave 1 based off of the low of wave 2. And of course, often much greater than that. But that is kind of, I would consider kind of a minimum objective for a wave 3 is a 1.618 relationship to wave 1. And then you'd be looking for a 4th wave pullback. Now, typically, if you had a deep wave 2, you'd be looking for a shallower wave 4, and actually the most common wave 4 retracement level would be 38.2%, and then I think the next most common would be 50%. And of course, the rule is that wave 4 cannot end in the price territory of wave 1, so you can't have that wave 4-1 overlap for it to be a valid wave 4. And then you get that final move up in wave 5 to above the wave 3 level. And again, there's more nuances, but I think I'll just leave it at that. And then after a 5-wave move up, you will be looking for some sort of larger pullback in a continuing trend to the upside. So another motive wave is what's called a leading diagonal. And that's where you also have a 5-wave move, so 1, 2, 3, 4, 5. But in this case, wave 3 must be shorter than wave 1. Wave 2, is typically fairly deep as well. And then wave 4 must enter the price territory of wave 1. And then wave 5 must be shorter than wave 3. So you have kind of this rising wedge or contracting nature here in a leading diagonal. One more little nuance to point out here on the impulse wave. So wave 3 is typically the longest, but it doesn't have to be as long as it's not the shortest. So of waves 1, 3, and 5, wave 3 just can't be the shortest, even though it tends to be the longest. You could have a wave 1 that's longer than wave 3 as long as wave 5 shorter than wave 3. Or you could have a wave 5 longer than wave 3 as long as wave 1 is shorter than wave 3. It just can't be the shortest. That's the real hard and fast rule of wave 3 in the impulse wave pattern. Okay, we'll move on to bullish corrective waves. Now I say bullish because these are correcting the trend in a otherwise larger bullish trend. So the focus would still be the upside after these corrections took place, right? You'd be looking for another move up after these corrections completed. So the first one is zigzag. That's a simple A, B, C down. Typically, the most common relationship would be A versus C being similar or equal to in length. Usually the B wave isn't all that deep, maybe a 38.2% or 50% retracement, although technically as long as it doesn't get above the origin of A, and you have the proper subdivisions 5 down, 3 up, 5 down, it can be considered a zigzag. Now in a flat, you typically have a more sideways look. So you have A down, B up, C down. And the subdivisions of the flat are typically 5 waves down in A, 3 waves down in A, 3 waves up in B, and then 5 waves down in C. And there's variations of the flat. There's the expanded flat, which is actually more common than just the ordinary flat. And that's where the B wave makes a new high above the origin of A, and where the C wave makes a new low below the extreme of A. And then in the running flat, it's the same as the expanded flat, except the C wave fails to make a new low. Okay, so that is the zigzag and flat. And then there's also the triangle. So a triangle is usually a contracting range. Now there's some variations of the triangle. This one is just a typical contracting triangle. If you want to learn more about the variations, again, would highly recommend looking at those Elliot wave learning resources from the first video. But just to do it quickly here, so we have A down, B up, C down, D up. So in a ordinary triangle, the B wave fails to make a new high above where the A wave started the correction. The C wave fails to make a new low, and then the D wave, again, lower high, E wave, higher low, and you have this contracting range, and then you get the move up out of the triangle once it completes. So I don't want to spend too much time on that. We'll go over to the bearish mode of waves. So the nice thing about Elliott wave analysis is whether you're in an uptrend or sideways trend or downtrend, everything basically is the same, except in a downward trend you would just be inverting the impulse wave. Okay, so instead of looking for 5 waves up, you'd be looking for 5 waves down. Okay, in a larger unfolding downtrend. So you get the 1, 2, 3, 4, 5 down. All the rules and guidelines from the bullish impulse wave also apply, just in the opposite direction with the bearish impulse wave. And the same goes for the bearish leading diagonal. Okay. Now keep in mind there's also something called an ending diagonal. It's basically the exact same price pattern, but it appears at a different phase of a trend. It appears at the end. So if you had a ending diagonal to the downside, that would mean the next move would be a large move up because you just ended the overall sequence to the downside. If you had a ending diagonal in an uptrend, that would suggest a downward move. And again, would highly recommend you learn more about that kind of thing from those resources I mentioned before. Okay, that's bearish mode of waves. Now bearish corrective waves, again, everything about the bullish corrective waves, you just flip it upside down, and that is how you identify these bearish corrective waves. So in a larger move down, you'd be looking for 3 wave moves up. So a zigzag, ABC up, or a flat, ABC, or an expanded flat, or a running flat. And then you'd be looking for continuation down after the pattern completed. Same with a triangle. The preceding move would be down, and then you'd have this bearish triangle basically a sideways move, and then you'd be getting another move down. Now, a little nuance of the triangle is it precedes the final move in the sequence. So if you have a triangle and then you move down out of the triangle, at that point you shouldn't be looking much lower, because that preceded the final move of that overall down sequence. Or if it was an up sequence, the final move of that overall up sequence, then the focus should be on a reversal in the other direction. We'll get into some actual examples, but we're just going through kind of the theory side of this at least a bit. Now, this may be redundant if you already know a lot of Elliott Wave, or if you've never seen Elliott Wave before or know just a little bit about it. Hopefully this just whets your appetite to learn more about it. That's the only objective here that I'm trying to accomplish. If I did a comprehensive Elliott Wave analysis series, I mean, I could spend so many hours just on that, and I don't think that is what I should do, since there are other resources already in existence that are very good for that. So I don't want to be redundant there. Okay, now theory versus practice. With a trading focus, you don't want to spend time on a chart with no obvious pattern. So when you're looking for trade setups, if you don't see an obvious pattern, just move on to another chart where you do find one. Don't waste your time trying to squint at the chart and try and, painstakingly force a wave pattern that, works for you. That's not the idea here. The idea is, do I see a pattern I recognize? If I do, that's, put a little asterisk on that chart, put a little note on that chart. Okay, I want to spend more time on this later to potentially identify a trade and get a selection of them going, right? Now, there are variations of the main patterns with specific characteristics that you need to spend time learning. I think I mentioned that. So I'm just kind of scratching the surface here. You want to look for clear patterns that appear complete or nearing completion. So yes, as far as looking for trade setups, you want something that looks like it's almost ready or ready. And then you can actually plan a trade and define risk and expected reward and all that, and position sizing. That's the idea here. We just want to do analysis to inform a trading decision. We don't want to do analysis just for analysis sake. Now, when you're learning how to do the analysis, that's different. You should just practice and do lots of analysis, but that's not the focus here. Clear trade setups with defined risk reward is the objective. Okay, I think I mentioned that already. Now let's go find some examples out in the wild. Yes, let's do that. Okay. Now I actually want to look at this chart, YVR, just a random chart I came across, no particular reason. Liquid Media Group Limited. I have no idea what it's all about, but do I see a pattern I recognize on this chart? Not really. I mean, other than it being in a pretty established downtrend, with the odd exception of some spikes up, overall downward trend, I don't see any clear patterns here that I can, well, that I want to try and identify. I could force myself to try and label this with the Elliott Wave labels, but why would I do that? Why would I waste my time on this chart? This is the purpose of showing this, is that if you see a chart like this where there's nothing clear about it, don't waste any time, move on. Now, if we go over to, I like this chart, CCJ, Cameco Corporation. So I've already labeled, or at least partially labeled this. Now this is the weekly chart, so larger time frame. And I see a clear 1, 2, 3, 4, 5 wave move that appears completed now. And that looks like it completed on, sometime in November, without getting into the specific day there. And now, after I see a 5-wave move completed, I'm expecting some sort of proportional 3-wave correction. Possibly a zigzag or a flat. Kind of looks like we're in the zigzag camp here. And also, before I get into this corrective move that appears to be in progress, let's just kind of examine this. Okay, so we get a 5-wave move up for wave 1. Then we get an ABC down for wave 2. And what kind of Fibonacci retracement did we do? So we did just about a 50% retracement of wave 1 and wave 2, so that's good. And did we do a measured move here? So we had the initial move down in A, bounce up in B, then a next leg down in C. Okay, now let's do some relationships there. Hang on. So, did we get any kind of relationship between A and C? Well, here's the equality relationship between A and C, and you can see we did briefly stab down a little bit lower than 952, but largely C was of similar magnitude. Again, the kind of guideline is similar or equal magnitude to wave A. So you had basically A versus C equality combined with that near 50% retracement. So that was a nice kind of 5 up, 3 down. The next move you expected was some sort of wave up. You didn't know if it was going to be a third wave yet. Maybe this could have been an A up, B down with a C up to come, but you were still expecting directionally some sort of move up of now, as far as expecting the magnitude of the move up, you could have said to yourself, okay, well, this is just an A up, B down, expecting a C up. I'd be looking for basically a AC equality, so around 16 would be your conservative estimate for upside. If you were looking at this as a 1, 2, like say we hadn't had this happen yet, so you didn't know, 1, 2, well, wave 3, you'd be looking at, at least that, hang on, you'd be looking at that 1-6-1-8 relationship. And you can see that was achieved and actually slightly exceeded, and that would have been around $20, okay? So then after that happened, after you got that third wave up and it started backing off, you just said, okay, well, I'm expecting a fourth wave because we got the 1, 2, and the 3, so expecting a fourth wave pullback. So you would have done a Fibonacci measurement from the wave 2 low to the wave 3 high. And you also would have had the, now let me just remove some of these levels. You basically would have thrown up the most common ones, the 38.2% retracement and the 50%. Now we actually end up going to around the 50% retracement for the wave 4 of the wave 3. And then we had to move up off of there. Okay. And we didn't overlap the high of wave 1 with the extreme wave 4, so we didn't have 4-1 overlap. So we can consider this a valid 1, 2, 3, 4. Before we got the wave 5, the focus would still be, okay, expecting one more move up in wave 5. And then we got the wave 5 up, right? Now, this is actually a good example. The wave 5 was a good example of a leading diagonal. An ending diagonal instead of a leading diagonal. And we had, within the wave 5, we had 1, 2, 3, 4, 5. And let me just get rid of the line here. And let's just rearrange these labels a little bit for easier viewing. Okay. Now, again, we had this kind of rising wedge ending diagonal. So wave 1 was the longest wave, as it needs to be in a contracting, either leading or in this case ending diagonal. We had a deep wave 2. Then we had a shorter wave 3. Then we had a wave 4 that definitely overlapped nicely with wave 1. And then we had a wave 5 that needed to be shorter than wave 3. So let's just ensure that that happened. I already know it did, but let's just show our work. So length of wave 1. Wave 3 has to be less than the length of wave 1 off of wave 2. And you can see we were well below that level. Okay. And then we had wave 3. And wave 5 had to be shorter than wave 3 off of wave 4. And you can see well below that level as well. And of course, wave 4 overlapped as it had to with the price range of wave 1. So a very valid ending diagonal. So the expectation being that we were in the 5th wave and we were doing an ending diagonal 5-wave pattern, the expectation would be a large correction once that completed. And we appear to already be in the midst of that large correction. And I think it is a B, C zigzag in progress. And let me go through why I think that. So we got the 5-wave decline. Okay. I can count a nice 5 non-overlapping waves down for a proposed wave A. And then we had a 3-wave recovery. A, B, C up. For the wave B. And what kind of retracement did we do? Probably a pretty deep one. So let's get some other levels up here. Yes, okay, just about a 786 retracement. So wave B retraced almost 78.6% of wave A, which is completely acceptable. Again, in a zigzag, as long as you don't actually take out the prior high and you got the proper 5 in A and 3 up in B, you can be quite confident that there is a zigzag pattern in play. So I'll delete that fib level. Now the next expectation, now that we have 5 down for A, 3 up for B, we would be looking for another 5 down in C. So 1, 2, maybe we're in the 3, we need the 4, and the 5 down in C. Again, this hasn't happened yet, so we're just currently working with the information in front of us. But this looks like a pretty solid trajectory, okay? Now, if we go back to the weekly chart, zoom out a bit here. Let me get rid of these subdivisions just to clean this up. So what are we looking for potential downside objectives? So we have the length of wave A projected off the extreme wave B. And equality would get us to 1807, AC equality. And then maybe the 1.382 would be the next most attainable objective. And that's right around just under 15, which is also near the fourth wave of this previous impulse wave. So there's actually something called, in the Elliot Wave Principle book, there's something called the guideline for the depth of corrective waves. So after you have a 5-wave sequence up complete, a guideline for the depth of corrective waves is back to the prior fourth wave of 1 lower degree, and often near its termination point. So often near the low of that prior fourth wave of 1 lower degree. Okay, so that is kind of a guideline target for this corrective move that we're in. And also Fibonacci retracement of this overall 5-wave move up in CCJ. So let's throw up the 38.2% level, 50%, 618. Let's just start with that, see how we're looking. Okay, so we're almost at the 38.2% retracement. That would be a fairly shallow retracement, but it would at least satisfy the minimum expectation of going below this A wave. So you could have a very weak C wave that barely takes out the A wave. Although that's not as common, it can certainly happen. So that would come into play around 1963, so mid-19s. Now, the 50% retracement comes into play at 1690, so around 17. And then the 618 gets us down here around 14, so 14 and change. So you can start to see kind of a confluence combined with, you know, the pattern still unfolding, an area where you might start wanting to be getting interested in looking at this for an entry for, since we have the 5 up, looking for that 3 down. After that, you'd be looking for the next 5-wave move up to new highs above 2849. So that's the idea behind just carving the chart out into chunks, kind of determining where you're at here in the overall trend, and trying to inform a trading idea with some analysis. Let's just move on to something else here. I don't want to spend too much time here on CCJ, but you can see what I'm getting at. Okay, I wanted to show an example of a leading diagonal instead of an ending diagonal. So a leading diagonal motive wave. So here's Toronto Dominion Bank. I believe this is the Canadian listed one on the TSX. And okay, we had the big sell-off into March of 2020. And that's where a lot of things bottomed out, right? Now we started working our way out of that bottom. Okay, it starts choppy. This often happens after an extreme move down, by the way, is you get this kind of rising wedge. You see a series of higher highs and higher lows, but it's choppy. That doesn't mean that it's corrective and we're going down again, though. That's why the leading diagonal is an important pattern to be aware of. So, okay, we had the wave 1 up, or the initial move up. We had some sort of corrective move down to a higher low, another move up, another corrective move down to a higher low, and another move up to a higher high. Now, let's just make sure that wave 3 is shorter than wave 1, which it needs to be in a contracting leading diagonal. Yes, wave 3 was shorter than wave 1. Now, I believe I checked this already, but just to show the work. Let's take the length of wave 3 and make sure that wave 5 is shorter than wave 3. Yes, it is. And obviously you had wave 4 enter the price territory of wave 1, so that's all good. So we have a very clean leading diagonal. Now, 5 waves up for a leading diagonal. At this point, we didn't know whether this is just an A wave up or a 1 wave up. But either way, we had a motive wave. So the direction of 1 larger degree was implied to be up by this motive wave, this 5-wave move up in a leading diagonal. So that's not where you want to enter a trade. You want to say, okay, well, what's the next correction look like? Well, we did get a 3-wave correction down to a higher low. So we had this initial move down, 3-wave move up, and then another move down. So an ABC. Now, did we have A versus C equality, which is a very common objective? Not quite. Did we get a 786 relationship between A versus C? So we had between the 786 and the equality relationship for A versus C. What did we get for a Fibonacci retracement of this initial move up? Around the 50% retracement, between the 50% and the 61.8% retracement. Okay. So at that point, that was a viable place to try and enter to catch the next move up. Now, you didn't know whether the next move up was going to be a C wave, which would have been weaker, or a third wave. It ended up being a third wave, by the way. But you had a directional bias that was well informed by the analysis. You weren't looking for new lows. You weren't looking to go short and take out this low, right? Because of the analysis that you did. Because you had 5 up and 3 down, expecting the next 5 up. So at this point, like say you were here, or even here, okay, you jump the gun a bit. This is how you would define a potential, just buy side long trade. And okay, let's say we didn't actually buy at the perfect spot. We just bought here at 58.86, okay? While your stop, so wave 2 can never retrace more than 100% of wave 1. So if we took out the low, the setup is spoiled, something else is going on, we were wrong, and we need to reassess the situation, and we don't want to be in the long position. So that is the risk level from where we entered. And as far as the target goes, we would just do some common objectives. So we have the initial 5 up, and from the bottom of that, or actually, yeah, okay. From where we entered, we'll say, and let's say this was a little bit of a fake out against us after we entered, but we wouldn't have been stopped out because we weren't putting our stop unless it was at or below this level, because that's what would actually invalidate this pattern. So let's pretend we entered not quite the right time. That was our risk. And okay, if we were just looking for an equality move, so if this was just A, B, and looking for C up, we'd be looking to get to 77.25, and that would be a risk reward ratio of just about 2 to 1, so not great. But it's a reasonable trade to take given the directional edge you would have had with 5 up and 3 down, expecting another 5 up. That would give you a clear reason to expect it to go up instead of down. Now, if we had the 1.618 relationship, so if we were actually feeling a little more bullish, expecting a third wave to the upside, now 88.62 would be that 1.618 objective, and that, as a defined trade setup, if we entered here, stop was just at the low or just below the low, and that was our upside target, that would have actually been a much better setup, risk reward ratio 3 to 1. So that would be what I would call a high quality trade setup with a good risk reward ratio. And actually you can see, interestingly enough, we pretty much bang on hit that 1.618 objective, and then did another correction that led to another move up. Okay, so I don't want to keep going on with the TD chart, but just showing kind of the process here to take. What else? Oh, another example here. This is pretty good. So here's a nice triangle I recall identifying and trading in March of 2019. Now you might say, oh yeah, it looks great, but easy to identify after it already happened and you got the big move up and all that. Well, yes, that's true. But if you go over here, and I have a video that I will link in the description to this video. Here's a video I did on, well, looks like I uploaded on March 7th of 2019, titled Supersize My Triangle, please. Just a little play on the Supersize Me McDonald's lingo. But the main point here is that, okay, I identified a triangle pattern on McDonald's on the daily chart. I identified that it was either complete or very close to being complete, and looking for a move up, well into the 200s, and it was a viable setup at that point because you knew where your risk was. You wouldn't want to see it break below the lows of the triangle. Anyway, you can watch the video in the description that's attached if you're interested in it. But basically, I identified it correctly at the time, and it did produce the expected move, and actually it went even higher perhaps than I was expecting by a bit. It went in, I think, as high as $221. Yes, just about $222. Also, importantly, so remember, triangles precede the final move in a sequence. So in this case, I believe it was the preceding the final move in this impulsive sequence in McDonald's that started from, I believe, the March 2018 low. And after we got that big move out of the triangle, then we began a large move down. Okay, so the final move in the up sequence completed, and then we got a down sequence into the eventual March of 2020 low. Okay, so a good example I wanted to show, and again, I will attach the video that was posted at the time before the move up happened. I'll put that in the description. Okay, now that's McDonald's. Actually, this is probably good for the length of this video. And perhaps I'll continue on with this series. But I also want to advance to other things here, not just Elliott Wave. As important as it is for informing trading decisions, it's not the only thing. So maybe let me know in the the comments on this video if you want to see some more examples or a little bit more elaboration on Elliott Wave itself, or if this is a good enough rundown for you and you want to move on to some other technical things that I like to combine with the Elliott Wave analysis. Okay, because technical analysis isn't just about Elliott Wave analysis. Elliott Wave analysis is just the analysis of price on the chart, price pattern analysis. There's other forms of analysis that we will get into that I believe complement it quite well. Anyway, let me know what you think in the comments section. And I think that is good for this video. I'll see you in the next one. Thanks. Oh, actually, just one more side note. Here's a Bitcoin video I did. I uploaded, I believe, November 22nd, 2018. And this was anticipating a major large degree bottom in Bitcoin that would eventually lead to another move up to new highs, which was at the time around that $20,000 mark was the former highs. And believe me, hardly anyone at the time thought Bitcoin was ever going back up in any significant way again. Sentiment was extremely bearish, and there was all sorts of reasons why they thought Bitcoin was going to zero, Bitcoin's a scam, Bitcoin's a fraud, blah, blah, blah. All I was looking at was the wave patterns, and that was what was informing my opinion of Bitcoin's future trajectory. So this video was quite timely. I'll certainly link the description in it so you can have a look if you want. Again, you can see when it was uploaded, so I'm not just doing the after the fact, oh look at me, I called it. No, I really did. It's not because I knew some special information that no one else did. It's because I applied the wave principle diligently, and it actually turned out to be a very accurate interpretation. And let me also click on this one. And this was after the actual bottom had happened, a little later on after that November 22nd video. And then I actually identified the initial trade setup. So we had the initial 5-wave move up and 3-wave move down, which would end up being a very significant trade setup at the time. And again, just following the wave principle to inform a trading decision. I'll attach this in the description of the video as well for you to look at if you're interested. And this is from January 13th of 2019, and the title was 5 up and 3 down. So pretty self-explanatory. Anyway, that's the end of the video. See you in the next one.